The put-call ratio is a ratio that is a form of measurement of the puts and calls in a security or in the market and their figures relative to one another. To understand the put-call ratio, one must first have a sound understanding and interpretation of the two figures individually, that is, put options and call options, prior to a holistic relationship of them together. A put option is a derivative that gives the holder/buyer the right but not the obligation to sell a security at a predetermined price. Buyers of puts are those that are looking to hedge or speculate on the price of a security going down. Subsequently, a call option is a derivative that gives the holder/buyer the right but not the obligation to buy a security at a predetermined price. And therefore, buyers of calls, as you can probably guess, are those that are expecting or anticipating the price of a security to go up so that they can profit and benefit off this movement. If we're looking at a stock, essentially if you think the stock is going to go down, you buy a put so that you can sell it at the price and no longer have to suffer selling it at a lower price. And if you think the stock is going to go up, you buy it so that you can sell it at the higher price in the future. Obviously, buyers of both calls and puts are buying these financial instruments for a reason. The expectation of a direction of a security or the market is based on one's understanding, insights, and interpretations of various micro and macro events unraveling. The put-call ratio gives one a broad outlook to the relative standing of those that are bearish versus bullish, and thus gives us an ability to gauge the market and its sentiment. Given that the market is both derived and moved based on investors, this sentiment indicator can be useful to anticipate direction and ultimately to profit off this direction. Some key facts to consider. The put-call ratio is based on the options market. They can be used to look at an individual security or the market as a whole. Many financial experts use this ratio as supplemental info to gather a better understanding when making their investment decisions. You can use the put-call ratio to go with the crowd or to go contrarian against the market. Both strategies throughout history have proven to be, with adequate implementation, very profitable. So when looking at the call versus the put volume in the market, a put-call ratio of 1 simply means that the amount of puts versus the amount of calls are equal. And a put-call ratio of 2 means that there are twice as many puts as calls. Obviously, in this made-up example, investors would be very bearish. Normally, throughout the history of the markets, a put-call ratio of about 0.7 is considered standard. And this makes sense because the general direction of the market, excluding big crashes and periods of panic, is generally up. Markets move up more than they move down. You often see big spikes in the put-call ratio when a big date or a big announcement is coming. For example, if a biotech company is releasing the results of a clinical trial study, or on the more macro scale, if there's a Fed meeting, an election, or an economic data release. Whatever it may be, wherever your direction is in the market, and however you value stocks or other investments, the put-call ratio is a useful tool so that you can see what others are doing around you. We want to thank you guys for listening. If you enjoy our content, don't forget to give us a like, comment, subscribe, and we hope you have a nice day.